So for the next evaluation performance of the investment center, so this video lecture will discuss about the economic value added, or EVA. Okay, so economic value added is another measure, okay, of profitability for the performance evaluation of investment center. Okay, so this is after tax operating income minus the annual cost of capital, or minus the total annual cost of capital. Okay, so your EVA is if the result of your economic value added is positive, so the company, or meaning to say the company is creating wealth. Okay, however, if it is negative, then this is the opposite. Okay, wherein the company is destroying its wealth. So over the long term, only those companies uh, that creates capital or wealth can survive, because here they have the leverage of the sources of funds to finance for their daily activities and operations. So many companies today use this evaluation of the performance to adjust management compensation. So basically, the purpose is to motivate the manager to uh, perform better, okay, with their responsibility areas. So this measure also encourages managers to use their existing and new capital with or for a maximum gain. So with the limited resources, their objective is to generate more income. So that's efficiency. Okay, so to determine or to solve for EVA, so we have the following formula. Okay, so here we have after tax operating income minus the weighted average cost of capital, or WACC, times the total capital employed. Okay, so here we also, based on this equation, you can see here that EVA is measuring the efficiency also and effectiveness of generating income. Okay, because we consider here the cost of capital and the total capital employed. Okay, so to calculate the weighted average cost of capital, so the company should identify all the sources of their invested funds. So it may be from their shareholders or creditors. Shareholders are funding through their investment, whereas the creditors, the company borrows from the creditors so that they will be able to comply with the requirements of additional funds needed for operations. So here, typically, as mentioned, so the sources are borrowing and equity. So either bonds or issuance of stocks. So the borrowed money, if the company borrows with bonds or other instruments, so it has an interest rate attached to it. Okay, and the rate is adjusted also for its tax deductibility. So please take note that in solving for net profit, our interest expense, okay, from this borrowing is deducted. Okay, that's why we will adjust, okay, for its tax deductibility in solving for the weighted average cost of capital later, to be used for solving or determining the economic value added. Okay, so to understand better, so we have here an example on how to determine weighted average cost of capital. So for example, if a company issued 20-year bonds, so this is a debt instrument with an annual interest rate of 8%. So the interest rate is, or the tax rate is 40%. So to solve for the weighted average cost of capital, all we have to do is to adjust this 8% with the tax deductibility of our interest expense. Okay, so just get the ratio. Okay, so here the cost of your bonds is 4.8 instead of 8%. Okay, again, the cost of your 20-year bond decreased because the interest has a tax deductibility feature. That's why it was reduced to 4.8. Okay, we adjusted its tax deductibility. So again, the weighted average cost of capital for the bonds is 4.8. Okay, what about if the source of fund is from the shareholders? So we will use the equity. Okay, so in equity, we will handle this differently. So the cost of equity financing is the opportunity cost to our investors. Okay, so over time, the stockholders have received an average return that is 6% points higher than the return on long-term government bonds. Okay, because here, the higher the rate or the interest or the return, the higher the risk as well. Whereas for the government bonds, it has a lesser risk, so there is also lesser percentage of rate return. So if these bond rates are 4%, then the average cost of equity. So here, for equity, we just use the 6% rate of return. Okay. And then, for example, if the bonds is 4% or 4.8 as what we have sold earlier, so all you have to do is to add, okay, to get the average cost of equity. So that's 10%. So this is how you calculate for the weighted average cost of capital. So riskier stocks, okay, as mentioned, they have higher return, whereas more stable and less risky, they offer lower return. Okay, that is actually the concept of investment. The higher the risk, the higher the return. The lower the risk, the lower the return. Okay, finally, the proportionate share of each method of financing is multiplied with the percentage cost, and then they sum, or we will add them to yield the total amount of capital that is being employed. So this is what we will use to solve the economic value added later. Okay, so we have here an illustration to explain, okay, further how to determine your economic value added or EVA. Okay, so for this company, they have after-tax operating income of 1,583,000. So they have three sources of financing. So they have 2 million mortgage bonds with 8% interest, 3 million of unused bonds with 10% interest, and 10 million in common stock or equity. So it is considered to be more or less risky. Okay, so it has an average return of 6%. Okay, so the company pays a marginal tax rate of 40%. Okay, so first, before we go to the determination of your economic value added, so we will compute first the weighted average cost of capital. So we will determine each of the sources. So based on the problem, so they have three sources. Okay, so the first source is mortgage bonds. Okay, so we will adjust it with its tax deductibility. So therefore, instead of 8% interest, it was now 4.8. Okay, for the unsecured bonds, so our interest is 10%, just like your mortgage bond. So we'll adjust it with its tax deductibility. So therefore, from 10%, it's now 6%. Okay, it's weighted average. For the equity, so they have the common stock. Okay, so this is 12%. Okay, because in this case, it has the rate of return. Okay, so we will add the long-term treasury bonds, okay, with that of the average return for the equity. Okay, just like what we have mentioned here. Okay, so if this bond rates are about, okay, so we just add Okay, this is for the equity. So therefore, the weighted cost of average for your equity or common stock is 12%. Next, okay, to get the weighted average cost, okay, so we will use this table. So we have here the amount for each source. Okay, so the percent. So the percentage is from dividing the amount over the total value, okay, of the financing. So for example, for mortgage bond, that's 2 million, okay, divided by 15 million. So that's 0.13 or 13.33%. Okay, and then what you're going to do is to multiply it with its after cost, okay, or weighted average right here to get the weighted cost. Okay, and the same also with the other two sources. Okay, so therefore, the total weighted average cost of capital for these three sources is 9.84%. So we will use this and to multiply it with the amount of capital employed. So that's 1.476. Okay, so we can now solve for our economic value added. So all you have to do is to deduct from the after-tax operating income, okay, the value that we have determined in this process right here. Okay, so therefore our EVA is 107, so it's positive. So here, meaning to say, or this indicates that the company is creating capital because our EVA is positive. Okay, so what if all 15 million of financing were from common stock? So of course, there will be changes. So here, we will multiply 12% with total 15%. So that's our weighted average cost of capital. And then our the effect here, as you could see, is it makes our EVA negative. Okay, so this is because if we will use only the equity source, it has no tax deductibility, can like that of the debt instrument or bonds. Okay, and there should also be a balance between the sources of fund from creditors and shareholders. Okay, but on the other hand, this is also, for this case, is also um, ideal because there are no other outside creditors who has the claim over the assets. However, it just makes our EVA negative. Okay, so that's all for our economic value added.